gold from a technical standpoint is in an uptrend. It's in a long-term bull market. It's in a favorable condition. And I think this is going to want to push up. The next upside target is about $3,750 per ounce for gold. And really, it just needs to work itself through this consolidation. If we were to kind of go to the extremes, there's still potential for silver to run up to about $38, which is something I think you and I talked about last time. The next push is about $38. Again, I think we're going to see gold, silver, and miners want to push and move higher. And we have been seeing the gold and silver miners actually perform very well.
Gold markets remained steady on Wednesday, showcasing resilience amid a noticeable shift in investor focus from geopolitical tensions to monetary policy outlooks. Despite easing concerns over Middle East conflicts, gold held firm as market participants awaited clearer direction from the Federal Reserve regarding potential rate adjustments. ChrisVermeulen, chief market strategist at the Technical Traders, noted that the long-term monthly chart for gold presents a strong technical pattern. The metal has completed a 100% retracement of its recent rally and pullback, suggesting consolidation near record highs. Vermeulen explained that gold is at a crucial point, either preparing for a breakout or entering a pause phase. The yellow metal surged nearly 3% as investors sought confirmation that tensions between Israel and Iran would not reignite and looked for more clarity on the Fed's next steps. Vermeulen added that gold's muted reaction to recent global flare-ups is surprising, but technically, the setup remains bullish. He projects a possible move to $3,750 per ounce as uncertainty deepens and gold continues to attract safe haven demand. Gold extended modest gains into Thursday, trading at $3,335 per ounce, while silver hovered near $36.35, posting a 0.2% increase for the session. The upward move coincided with a weakening U.S. dollar index, which slipped to its lowest level since March 2022. However, resistance for gold remains in the 3,345 to 3,360 range, while silver faces similar pressure around $36.42. The recent ceasefire in the Middle East helped stabilize risk sentiment and spurred a minor rebound in equities, tempering safe haven inflows into precious metals. Still, Vermeulen pointed out that silver, often trailing gold, has recently shown renewed strength. Once gold's momentum eases, investors frequently shift to silver, which now appears poised to test resistance at $38, a key level from the 2011 and 2012 cycle. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Yeah, I mean, this is the long-term monthly chart. It has a very strong chart pattern. I mean, we can use Fibonacci extension and base price off of this recent run up. We've got this pullback down here. We can carry it forward. We're testing. We're right in that area where it's trying to figure out if it's going to stall out or start another run. So the monthly chart right now has hit its 100% measured move based on the most recent run and significant pullback. But when we drop to the daily chart, there's no doubt gold is still in a strong uptrend. And if we drop to the daily chart, what we have seen is gold has just like in the past, it rallies up and then it consolidates for a while. It's rallied up. It's consolidating for a while. It is trading right up near all-time highs. There's a ton of uncertainty. There's war. There's all kinds of things, wars going on. And this is really just a consolidation. Gold, from a technical standpoint, is in an uptrend. It's in a long-term bull market. It's in a favorable condition. And I think this is going to want to push up. The next upside target is about $3,750 per ounce for gold. And really, it just needs to work itself through this consolidation. I am surprised gold didn't really take off in the last week or so with what's been going on in the news and overseas. But overall, it continues to hold its value. And I think it's going to want to push higher as the uncertainty and fears continue to creep in. So you definitely do not want to be betting against gold. I hold a lot of physical gold and silver for the long term. Overall, we did play a gold move. We're out of gold as a short-term trade, but long-term investors, I mean, gold really is, I think, a solid investment long-term. And you just have to ride out the waves that come with it. But it is pointing to higher pricing still. Yeah, I'm more bullish on gold. I think the stock market, even if it pushes higher, or if the stock market trades sideways and pulls back, I think gold is going to hold its value and potentially actually push higher. So to me, gold has the least amount of risk and will hold its value and potentially move higher more. It's like today when we look at the stock market, we have the NASDAQ is up and the Russell 2000 is down almost 1%.
Yeah.
The SPYD, which is the dividend space, the top dividend stocks in the SP 500 is down 1.2%. And that's just telling us, right now people don't want the boring stuff. They're not really moving into gold. They're moving out of boring dividend stocks, and they're moving into the ARK ETFs. They're moving into Bitcoin. They're moving into growth and aggressive stuff to try and make a bunch of money. And I get that, but that to me is a warning sign. And I think gold will flip and extend higher during this over the next week or two, and want to push up towards that 3750 while the stock market starts to struggle with these all-time highs. I think we're going to see the stock market gap to all-time highs, get sold off and rally back. I think it's going to be a volatile 1 or 2 weeks as the stock market tries to mess with investors. Like, is it a new bull market? Is it, just a topping phase and a fake out? And that's what everybody's trying to gauge. I think that's why it's a little quiet today. Yesterday was a big move. People are they're scratching their heads going like, okay, what's going on? Is this like the real deal? Is this just manipulation and news driven move? That's what people are trying to figure out. And same on my side is,
Well,
what is
let's
this
take a
market
look.
doing? It
Yeah.
comes right back down to last November through the end of the year. The price action is actually very similar to what we saw before. If you look at this, we had an initial sell-off. We kind of had a bounce and a bounce and a pullback, and then eventually it started to work its way up. We've kind of had the same. We've had a pullback, a sharp pullback, a couple bounces to the upside, and I think eventually we're just going to see this continue to go higher. This is just a typical consolidation. What I like about this move that we have right now, which is kind of similar to this one over here. You have a pullback, you have a bounce, and then it sells off with some big volume. Well, we've done the same over here. We pulled back, we had a bounce up, and then we came down to a lower low. It's called an ABC correction. So you have an A, B, C, and the break of this little pivot low here creates panic in the stock market or in gold. People bail out of it. It's that lower low that spooks people out, and then the market starts to want to firm up and go higher. We kind of had the same over here. The market pulled back, it had a bounce, and then it sold off. We had a lot more fear. There was a lot of technical levels that matched up with this high that we had over here, which is why I think we saw an extra bout of selling pressure. But overall, we've had the same type of scenario where it's flushed the market out. And I believe we're kind of like right here, right now. I think the market, gold is going to start to firm up and start to go higher. So I think if there's a place to get into gold, I think this is kind of it. I think from here, it's going to want to work its way up and to the right over the next 1 to 2 or weeks or longer. And this is what I see fairly often. Like, gold is to me is the most consistent barometer for trading and for getting global sentiment. Gold started to flatline and stall out, and silver had this huge takeoff. And usually that's what happens. We kind of see kind of savvy investor money looking for safety and security and low volatility. They move to gold first, and then it becomes kind of the play that whoever's going to go to gold is already in it. And then eventually it starts to kind of get boring, and then investors are like, well, what's the next play? And then silver suddenly pops and takes off. And that's what we've seen just based on this rally here using Fibonacci extension. I mean, gold, you and I had talked about this. It came up and hit this 618 level of a Fibonacci extension. If we hit this level, we generally go up and hit the 100% measured move. And so we've hit that. And now we got the volatility, and silver's trying to figure itself out. If we were to kind of go to the extremes, there's still potential for silver to run up to about $38, which is something I think you and I talked about last time. The next push is about $38. If we zoom way back on the charts here, it's a very significant resistance level on the chart from back in time. I got to go way back here to 2011, 2012 level. But overall, if we come back here, we're going to be coming right up to a major significant spike in price before it really had a sharp reversal. So again, I think we're going to see gold, silver, and miners want to push and move higher. And we have been seeing the gold and silver miners actually perform very well. If we look at GDX, for example, they have performed. They've been pushing to new like 52-week highs. The SILJ, which are the small cap silver stocks, they've had a huge pop, and now they have this nice pullback. If we take a look at the pullback, it has this A, B, C correction, which it breaks this little low, creates a bunch of panic, and usually a reversal. And this is a bull flag pattern. This is pointing to sharply higher pricing for silver miners. So if we have more uncertainty in the stock market, which I'm sure we will, I think we're going to see gold, silver, and miners really do well. And the fact that miners are now coming to life is a good sign. I think we're going to see one more big push potentially in the stock market, 5 to 8% to the upside, and we could see gold, silver, and miners actually have another big push and go higher. So the charts are looking favorable at this point for quite a few assets. That's the hard part with miners is you don't know if gold miners are going to get pulled down with the stock market or if they're going to buck the trend and go with gold. So it adds, you go from like a 50-50 coin toss to like you have a 33% chance of doing well with the miners.
Yeah.
That's the hard part. And that's why I always default back to gold. I'm like I'd much rather consistently make money than have a low probability play that moves really fast against you if you're wrong. So I do feel like kind of gold is still that boring conservative play. It's about making money, not about making as much as you can at this opportunity.
Right.
So yeah, that's how I would see it is physical gold itself or gold a gold ETF versus the miners. They carry a lot more lower probability of making money.
U.S. stocks rallied by more than 1% on Tuesday as investors responded positively to signs of easing geopolitical tensions following a tentative ceasefire between Israel and Iran. The market also closely analyzed Federal Reserve Chair Jerome Powell's congressional testimony for insight into future monetary policy direction. While Powell maintained a cautious stance, the relative calm in the Middle East appeared to lift market sentiment. ChrisVermeulen noted that if the S&P 500 breaks new highs and sustains that level for several days, ideally a week, it could strengthen investor conviction and potentially trigger a wave of short covering, attracting new long positions. The optimism was further buoyed by President Donald Trump's announcement of a ceasefire agreement late Monday, which, despite some reported violations by Israel, was largely perceived as a step toward de-escalation. The bulls are out of their bucking chutes, one analyst remarked, highlighting how the prospect of reduced conflict in the region is fueling the rally. Investors appear to be betting that geopolitical calm is a net positive for equities, even if it dampens bond yields and oil prices. Still, Vermeulen cautioned that this setup could be a classic bull trap. A 5 to 8% surge followed by a sharp pullback is a familiar pattern in markets, often designed to flush out short positions, lure in late buyers, and then abruptly reverse course. For now, though, optimism remains in control, with equities surging as geopolitical concerns momentarily recede. Let's get back to the interview.
Yeah, so looking at the markets, obviously, over the past couple of weeks, I was away. I was hiking Kilimanjaro, and I came back to my inbox. It was pretty full with people saying how panicky the market has been. It's been volatile. But what's really interesting is actually when you look out at the price action over the past couple of weeks, it has been very kind of flat and boring. A lot like today. We've not a lot of volatility, but we've definitely had a ton of headline news, extreme news that definitely makes every little wiggle on the chart feel like a crisis. We've had the ceasefire. We've seen the stock market have with markets kind of coming to life this week. And today people are in pause. I think there's a lot going on. People are debating like what is going on with the stock market? What is going on with the global kind of war situation? We got the Toronto Stock Exchange hitting new all-time highs yesterday. The NASDAQ is flirting with all-time highs today. People don't know what to do. Either people have been betting against the falling market and they're deep underwater. The trades are going against them and we're hitting new all-time highs, which has people kind of frozen. When people get nervous, they freeze. They just don't do anything. And then people who aren't long the markets, they feel like they're getting left behind and they don't know what to do. Is this a real breakout or is this a fake out? And with the news with the ceasefire yesterday, people are kind of wondering, okay, is this just like a headline news and nothing's really changed? I think we've really learned in the last like 6 months or so that a piece of news comes out and there's a new rule set, and then like by the nighttime the rule's been delayed or moved, and so now everybody's like really questioning all of these big news pieces. Are they real? Are they going to change? So I think people are just nervous at this turning point. It's like most people are either on the wrong side of the trade or not involved in this rally, and people are frustrated. And now we have the ceasefire and new all-time highs, and they don't know what to do. And that's why I think we have a bit of a lull in this market, as you said, David. Yeah, well, once we break that level, from a technical standpoint, people who are short the market, meaning they're betting on falling pricing, they're going to naturally want to and somewhat have to cover because now the market will be hitting new all-time highs. So what the market is good at doing is always trying to make a nominal new high or a nominal new low to try to run the stops, to try to push people's emotional triggers to make them eject out of trades. And so if the stock market makes a new all-time high, there isn't any overhead resistance. That's the problem with holding an inverse play or betting on falling pricing when the market hits a new highs. There is no resistance. So if we hit that level and say it can hold for a day, say ideally it would hold for a week into a new high territory. People who are short the markets are going to want to cover. Also, they're probably going to want to get long the markets because now we're at all-time highs and the trend is up, and you generally want to be trading with the trend. So, the market probably needs to hold up for a week or, in general to say, okay, it's holding that level. But right now it's just in that turmoil. People don't know, is this a real breakout or not? Like the S&P 500 is stuck under resistance. If we look at the QQQ, for example, which is obviously tech heavy, it is actually already poked and is trading above to new all-time highs, which the Magnificent Seven are doing a bunch of that lifting. So on one side, we have the NASDAQ hitting new all-time highs. The other side, the S&P 500 hasn't quite. And, we're in this turning point. We're in a strong uptrend right now. We've had this, what I called a dead cat bounce, which you and I talked about, I think pretty much on the day the bottom was put in place. Expect a very strong bounce. And this bounce is dragged out, and now we're testing all-time highs. And now it's kind of converting from potentially a dead cat bounce to a double top or maybe a nominal new high. But we got to be very aware this could very much so be a shakeout. This is what the market does. It'll get the shorts to cover. It'll get people who aren't long finally to get long, and it could create a pop. I show the NASDAQ and the S&P 500 could rally 5 to 8% over the next couple of weeks and then have a sharp reversal. That would be kind of like an unwinding of people who are on the wrong side of the market and also people who aren't involved yet to pile in and kind of push the markets higher. So this is something you and I actually talked about many, many months ago. I said maybe the market comes up and makes a nominal new high. It sucks traders in, it gets the shorts out, and we're starting to get to that scenario because the Russell 2000. If we pull the Russell 2000 up, which is kind of more of a broad market play, it is more of a growth stock play. It's not looking very healthy. It is stuck under the 150-day moving average. It's stuck under the big breakdown that we saw earlier this year. And on top of that, people are moving into the ARK ETFs. When we look at the ARK ETFs, this is the aggressive stock. This is where people go when they want to try and catch up and make money for, say, if they've missed the recent rally. If we take a look at just the chart of the ARK here, we've had about a 38% rally. And so this is leading the way. The ARK ETFs are right at the top of our hot list, meaning that's where money's piling into, volume's picking up. It's becoming the play that everybody wants. People think the market's going to go a lot higher. There's a lot more potential. And all these little things kind of tell me we need to be aware that this nominal new high in the stock market might be very short-lived. Ideally, it would have been nice if the dead cat bounce kind of stalled out below this level and then kind of rolled over. That would be ideal. It has instead muscled its way up. And now I wouldn't really say it's a dead cat bounce anymore. I would say, we got the huge bounce and rally, but now we're coming up to more so double, triple top territory. And now we just need to see how this is going to play. So, I mean, if I could pull that label off, I would say, okay, this is not a dead cat bounce anymore. Now we're going up for a double top or a nominal new high to see how this market plays out. And so that's kind of where we're at. This bounce has turned into a very strong rally. And now we just need to see if we're going to push to all-time highs and muscle higher for several weeks and continue to see the stock market grow, or is it going to create a lot of anxiety, a lot of emotional driven trades, the shorts to cover, longs to get in who aren't long yet, who have FOMO of missing out on any more rally? That's what we're trying to get a gauge now. So I would say we're more so in a double top-ish or triple top market environment, and we need to see if it's the real deal, a top, or if it is going to extend and continue to have another big push and rally to much higher levels.
So how would you be positioned right now?
Yeah, positioned, we're long the markets. So if we take a look, for example, like the QQQ here, you can see when the market started to roll over back in February, our strategy told us to get out. We were able to avoid the volatility and the crash. And then we started to get this bounce, and then the bounce turned into a really strong rally. We actually had a buy signal. So we've hit some targets. We've hit a 3%, a 10% target. We got another target way up here around 560 for the QQQ. So Even though I'm bearish on the markets and I'm thinking this could be a double top, or I thought it was a dead cat bounce initially, when the charts are showing strength, you need to follow the charts, not what you think or feel. And so we're long the markets. We're long the QQQ. We're long now the S&P 500, and we're also long IBIT. We're long Bitcoin, which has a very strong chart pattern as well, which, as you know, usually I'm not a Bitcoin fanatic, but this year and late last year we've had a few trades in it, and it is actually has very nice chart patterns, and it seems to be kind of a place to be at the moment. Yeah, there's no doubt the dollar right now is in a downtrend. It's trying to figure out if it can find a bottom or not, but it is all the moving averages are sloping down, the 150-day, the 50-day, the 20-day. They're all layered in the right direction, saying, okay, the trend is down. So right now it's trying to figure out, is it going to find some traction? We've had some huge volume. We've had very extreme price action. Usually these are early warning signs that the market's trying to put in a bottom. Doesn't mean the bottom is in, but it means it's getting closer. We've had a pretty big rally. We've poked down some nominal new lows. The dollar is definitely in a downtrend, trying to find support. The monthly chart, if we take a look at it, you can see here, in a nutshell, it's kind of doing the opposite of oil. Long term, when you look at it, it has a series of higher lows. It has a series of higher highs. More or less, it trades sideways. It moves up. It trades sideways. It moves up. It trades sideways. So it is more or less still, from a long-term investor. Like I move my money to US dollars. I've been doing that really since about 2010. And in the grand scheme of things, looking at this long-term trend, the dollar has definitely pulled back significantly, but to me, it's still within the uptrend. It is getting close to changing its long-term perspective, where I'll be like, okay, I don't want to hold the dollar anymore. At this point, it's still kind of hanging in there for where I'm going to continue to hold the US dollar. But if the charts start to turn even more and start to show a bearish pattern forming over the next couple of months, meaning more so a bear flag pattern, and it starts to want to break down, then I definitely want to get out of the dollar and I want to move over to probably the Canadian dollar, and go from there. And of course, if the dollar does keep continuing to collapse, that could send gold up sharply, and mix the falling dollar with war, and it points to much higher gold prices. So we really have to see. We're at a critical turning point for a lot of asset classes to have some major turning points happen.
Federal Reserve Chair Jerome Powell, in his latest congressional testimony, emphasized the central bank's cautious approach but signaled that rate cuts remain on the table if inflation continues to trend lower. Markets responded positively to his remarks, viewing them, alongside dovish commentary from Fed officials Michelle Bowman and Christopher Waller, as setting the stage for policy easing in the months ahead. Traders have now priced in a more than 85% chance of a rate cut in September, according to futures data. Additionally, markets are forecasting a total of 60 basis points in rate reductions by the end of the year. This shift in expectations has added momentum to both equity and precious metal markets, with investors positioning for a softer monetary backdrop. Momentum in financial markets continues to gather pace as shifting expectations around monetary easing reshape investor strategies. With central banks leaning toward a more accommodative stance and global tensions momentarily subdued, capital is finding new channels, rallying equities and reinforcing precious metals as anchors in turbulent waters. The interplay between technical setups and macro signals hints that the current calm may be a prelude to sharp directional moves across asset classes. Could this emerging alignment between fiscal policy shifts and technical breakouts signal the early phase of a broader reallocation wave? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.